Hey everyone, welcome back to Quinn Talks Money. Today we are just going to be going over some basic stock terminology. Just to make sure that when we're talking about stocks, when we're talking about money, you have a good understanding of what all these different terms and ratios and acronyms and things like that I'm throwing around. So that's what we're going to do today. If there are any questions about certain terms that I'm talking about as we go through this, just feel free to comment below. We've had some great comments on the last few videos, so feel free to comment with any other questions on the terms, or if there's any terms I don't go over today that you want me to talk about. So let me know in the comments, and then also while you're at it, hit that like button, helps with the little algorithm, and then also hit that subscribe button. We're almost at 50 subscribers, which is awesome, so thanks everyone, and let's jump in right to it. So the first thing that we should talk about is what is stock. So stock is basically a portion of a company that you have the ability to buy. So a company is basically split into a bunch of different pie slices in a way. So you have one whole pie, and a company can be split into multiple different owners and different percentages that you can actually own. So as an investor, you're basically buying the opportunity to have some small portion of that company. So basically like a stock in a company, or one stock, one share of the stock is basically like one super tiny slice of a pie. And as a super oversimplified version, let's say that you have like a bakery. So it's a non-public company, it's just a bakery. And let's say that there's two potential shares, or there's two like pieces of stock that the company might have. So if you own 50% of the company, you own one share of the stock, or you own one share of stock of that company. So that's just kind of like a super simplified version, but stock is basically just a part ownership of a company that you have. So let's talk about what is a public company and what is a private company. So a public company is anything that can be traded publicly on a stock exchange. So this is usually set for very large companies that have a lot of shares. An investor like you or me, someone that may not be extremely rich, can go out and actually buy a small portion of those businesses. So that's what a publicly traded company is. It's examples like Apple, Google, Disney, Netflix, Facebook, Starbucks. Those are publicly traded companies, really large companies that are able to be traded or be able to be bought in really small portions of shares or stock by average investors and also large investors as well. And a private company is something that is not necessarily able to be traded as frequently or as rapidly on, let's say, a public market or a stock exchange that you might hear about. So a public company is one of those large names that actually is selling shares to the general public, whereas a private company, maybe it's like a coffee shop, and you can't just go buy a share of the coffee shop on a stock exchange. You'd actually have to go like talk to the owners, negotiate, and things like that. So that's what a private company is and a public company. A private company also doesn't necessarily give their financials, so you wouldn't necessarily know the financials of a private company, whereas public companies are required to actually say their profit, their loss, their revenue, all these different financials every single quarter. They have to report those out to the general public. So now let's talk about how you can actually know if the stock market is doing well or not. And typically you will hear words S&P 500 and Dow Jones. Basically what the S&P 500 and the Dow Jones are is they're what's called indexes. So basically they track the entire stock market in a way. So they don't necessarily go into every single stock and track those, but the S&P 500 will track 500 of the highest value stocks or the highest value companies in the country. And basically by tracking all 500 of those companies, you're able to see a broader view of how the stock market is doing as a whole, rather than having to look at every single individual stock to see how they're doing. So with the S&P 500, if you might hear the S&P 500 went up 1% today, basically what that means is as an aggregate, all of those 500 companies basically averaged a 1% gain over that day. And then the Dow Jones Industrial Average tracks 30 of the largest companies as well. So typically the S&P 500 is used a little bit more prevalently in terms of how the stock market is actually doing, just because there's 500 stocks involved in there. But the Dow Jones is also from like the 1800s, late 1800s, it's been used to also track the success of the stock market with 30 of the highest value companies or blue chip companies in the country as well that are publicly traded. And what is an IPO? An IPO stands for Initial Public Offering. And basically what this is when a private company decides to go public. So basically a private company says, hey, I need to raise some money to grow my business. So what they do is they change from a private company into a public company, and they go out and sell shares on the market to normal investors like you and me, or institutional investors, to actually go raise more money. So on the day that they have their IPO, basically what they're doing is they're saying, hey, we have all of these shares, or we have a new slice of our company that we want to sell so that we can raise money. So by selling those shares on the market, you might go out and buy a share, let's say for $10. So then in exchange for one share of the company, that company now gets $10. So that's basically what an IPO is. It's basically taking a company from being private into public, and by being a public company, it now means that their shares are going to trade on an exchange for investors like you and me, or for large institutional investors as well. So when you go public, each company gets to choose a ticker symbol, and a ticker symbol is basically a shortened version of the company's name. So in the case of Starbucks, it's SBUX, or in the case of Disney, it's DIS. Google is GOOG. So basically it's a shortened version of the company, so that when you're going and searching for prices and searching for quotes, you can just type in the little ticker symbol rather than having to type out the whole company name. So a market cap is actually the total worth of a company, or basically the shares of the company and the share price. When you multiply the shares of a company and the total share price, that gives you the market cap. So basically it's saying on the market right now, the going rate for this company is X amount of dollars. So Apple and Amazon are typically trading right now around a $1 trillion market cap. So if you as a normal person just wanted to actually go buy Apple tomorrow and you had $1 trillion in the bank, you could go out, buy up all their stock, and then you would now be the owner of Apple. So basically the market cap is what is the company worth on the market today. So if you wanted to buy 100% of it, what would you typically have to actually go buy the company for? And there's a little bit of other nuance in there. If you actually did want to go buy the entire company, sometimes it wouldn't actually be the exact price of the market cap, but that's kind of what the simplified version of what it actually is. So you might also see shares outstanding. So basically what this means is how many shares are out on the market to be bought and sold every day. And each company will have a relatively fluctuating number of the shares or the portions of their business that are out there to be bought and sold. And so when you see shares outstanding, it basically means like how many more pie slices of the company, or how many shares are actually out there to be bought and sold by investors every other day. So earnings per share, or EPS, is basically what happens when you take the entire profit of a company, divide it by the shares outstanding, and basically what you're getting is the amount of profit for every single share of the company that is available. So you as an investor, let's say you bought a share of a company for $100, and you basically see that, okay, after all the profit is divided by the shares outstanding, there's $10 of profit for every share, or the EPS, the earnings per share, is $10 per share. So basically what that's saying is that for your share that you bought of the company, $10 is technically associated with that share of the company. So basically all it's allowing you to do is, because some of these companies have so many shares out on the market, it's allowing you to see a condensed version of what the actual earnings are for every single share that you might own of the company, or what is the profit for every share that you own of the company. A dividend. Dividends are a big topic. It's an income source for a lot of stocks, and basically what a dividend is once a company makes a certain amount of profit within a quarter, or even let's say within a year, basically what they sometimes do is they'll pay some of that profit back to the shareholders or back to the stockholders. So if you are an investor in a company and they have a dividend, basically what you can expect is that every single quarter, typically is how it's done, you will basically be getting a check in the mail, or in your brokerage account you'll get some money deposited. And basically what the company is doing is they're taking a portion of their profit and paying it back to the shareholders. So it's kind of a way for you to make income, it's a way for you to make back in your investment, and it's a way for the company to actually reward the shareholders who are investing their money in that company. So a dividend is basically a part of the profit that the company is paying back to their shareholders rather than reinvesting in the business themselves. A yield, or a dividend yield, is basically a percentage of the earnings that are paid out as a dividend. So for you, let's say the dividend yield is 10%. Basically what that means is that whatever the stock price is today, 10% of that stock price is paid out every single year in a dividend. So it kind of allows you to kind of see what your return on the initial purchase of that stock might be. The yield does fluctuate depending on the stock price. So let's say you buy a stock today for $100 and the dividend yield, or the yield, is 3%. So basically what that means is that within the next year, you can assume that you're going to make a $3 income, or basically dividend, for owning that stock throughout the year. And if you sell the stock before the year is done, your dividend might not be $3, might be less than that, but basically it's a way to recoup some of the money of your investment in the initial stock. A portfolio is a group of the stocks that you actually own. So let's say you own a few shares of Apple, a few shares of Google, a few shares of Starbucks, and a few shares of Berkshire Hathaway. Basically that comprises your portfolio, or your stock portfolio, and your investments. And a brokerage account is where that portfolio will typically live. So a brokerage account basically comes from the idea that typically in the past, before the internet was around, you had something called a broker, or someone that you would call to basically say, hey, I want to buy X number of shares of this company. And then that broker would go out and they would actually purchase those shares for you and hold the shares in some sort of account for you. So basically a brokerage account, you can still have that type of brokerage, which I just described, or you can have a lot of times an online brokerage. So if you're using an online brokerage, you might have something with Charles Schwab, Fidelity, TD Ameritrade, Wells Fargo, any of these types of companies that actually allow you to buy and sell stock online, and then they basically hold that stock in an online portfolio for you. A bull market is when the stock market is up 20% from its recent low. So basically you are in bull territory or a bull market once the stock has gone up 20% from a recent low, and you're in that bull market until you get to something called a bear market. And a bear market is basically the opposite, and that is when you are 20% below a recent high. So you are always in either a bear market or a bull market, and it pretty much just depends on where you are relative to a recent high or a recent low. And if you hear someone say that you're a bull, I'm a bull, it basically means that you are very optimistic about the future and you expect stocks to rise. If you are a bear, it basically means the opposite and you are expecting stocks to go down in the near future. And the last term that we'll talk about is probably an ominous term, but it's recession. What is a recession? And a recession is basically when you have 2 straight quarters of negative growth. So as the economy as a whole, we're basically tracking if the economy is growing. So for the most part, most quarters the economy is actually going to grow, but basically a recession is when you have negative growth for 2 quarters. So when the economy actually shrinks or it contracts for 2 straight quarters, that's typically what you would consider a recession, and you get out of a recession when you have 2 quarters of growth after that. So that's all the terms for today. Thank you for listening. Feel free again to comment in the comments if there's any of these that I didn't explain very well and you have other questions on, or if there's other terms that I haven't talked about that you would like me to go over. I appreciate you listening to Quinn Talks Money. We'll be back with another video in the next couple days. It would really help me if you could click that subscribe button, click that like, and also again, just comment below if you have any thoughts, any questions, and we will see you next time. Thanks so much for watching Quinn Talks Money.